Hey everyone, welcome to this week's edition of Midweek Market Update. I am Ashley Rosser, and I apologize, tonight's video is actually coming out a little later than normal. It's actually 8 o'clock here, and I unfortunately am waiting on my COVID test to come back. So I guess after you spend enough weeks talking about COVID, eventually maybe it becomes contagious to you, I don't know. But I am feeling well, just had some very mild symptoms on Monday and wanted to be careful and got tested, and so I've been avoiding the office while anybody else is here. So shout out to my nearly 14-year-old daughter who is working the camera for me tonight so that I could get this information out to our clients and our followers. And so today what I wanted to get into, it may be a little short today, but I wanted to get into just some things that we're continuing to see in the market, as well as an update with some of the positions that we took last month as well as last week. And so first thing I wanted to talk about is, I spend a lot of time talking about the breadth of the market, that it's very narrow, that as we see the market beginning to continue to have this acceleration in returns, that so much of it is concentrated in just such a small handful of companies. And so this was really evident again yesterday. So yesterday the broad-based markets were up about 0.77%. You say, wow, that's pretty good. That sounds like the whole market must have been doing pretty well if the S&P 500 was up 0.76%. Well, when we look at this heat map, actually, Apple, Microsoft, Google, Facebook, Amazon, they did have good days yesterday. A majority, though, of the other heat map, as you can see, was in the red. And so I just thought this was a neat visual to show that while broad-based markets do continue to see increases, very much so across the, when you look at the individual companies, they're not all having the same experience. And so I just thought this was a neat way to kind of display that for you. This is another way of really saying the same thing. And so here we have our broad-based indicators. We have the S&P 500, the NASDAQ, and then we have the FANG index. So these are our broad-based indexes here, utilities, Dow Jones, S&P, and here we have FANG index. So this would be Facebook, Amazon, Netflix, Google. Look at this divergence. So you take those companies out of the indexes, that's going to dramatically impact what our positive performance would actually have been. So huge divergence from where everything else is when you look at that just small handful of companies. And so this is not a healthy market. It still is not. Yes, we are seeing the market continue to have positive gains, but how long can this go? We don't know. But we just know that when we see such narrow marketplace, that is absolutely the sign that we should be concerned when we don't have broad participation. You remember last week, if you tuned in, I talked about the fact that one of the concerns that I have is that even though the S&P 500 hit an all-time high last week or the week before that, when you look at the number of companies in the underlying index who are also having new 52-week highs, very, very small, especially compared to February when we hit an all-time high. So again, narrow participation, volume is still down. We still see significant divergence from our 200 moving day averages, especially within the NASDAQ. NASDAQ is trading 3 standard deviations above its 200 moving day average. And as you'll remember, as a reminder, moving averages, they just act like magnets. So they pull you back down to that mean average. Eventually, that's the way averages work. You have to trend close, either below or below, to be an average. And so when we're 3 standard deviations above, that is absolutely something that's not sustainable. How long can it go? We're running on momentum right now, and we're just running on hope. And so momentum in of itself is bullish. So momentum can absolutely drag the market along. And so when we have companies like the FANG stocks right now that have significant amounts of momentum that can continue to pull markets along, just not forever. And so what my concern is that when we have some sort of triggering outside event, unexpected, that catches the markets off guard, the fact that we are completely overextended, that the market has narrowed, that we have very narrow participation, the fact that I already mentioned that volume has decreased, the fact that when we look to price to earnings ratio is completely disconnected. So we put all of these things together, it's just a sign that it could kind of like be a ticking time bomb. Put to call ratios are at all-time lows. And what that tells us when we see no or low put to call ratios investors don't see any reason to hedge their portfolios against risk right now. They are all in. They're saying, I'm in. This market couldn't do anything but go up. And when investors get to that point, that is generally the sign that things could absolutely go down. We see these at market tops all the time. Am I saying that the market top is tomorrow? No. Is it next week? We don't know. We just know that as investment managers, we have to look at all of these details and say, what do we do with this? So we need to be prudent. We need to proceed with caution as we're creating portfolios. And so these are some of the things that have kind of been in the background for the past weeks and months. So, however, we did last week take additional equity positions. So you may remember that in the third week in July, we talked about we had taken positions in industrials and construction, in innovative technology, and in consumer cyclicals. They had done very well, very pleased. We are continuing to hold those positions. But last week, we saw an opportunity that we could add 2 additional positions. So we did add a position in Equal Weight Technology Fund. It's a NASDAQ equal weight fund as opposed to being cap weighted, because right now cap weighting just basically means how much of the market cap that a company has within an index, they'll be overweighted. So we like being equally weighted right now. We think that that is a little more prudent. So we have an Equal Weight Technology Fund and a Consumer Discretionary Fund. And so we did add them. We found some entry points last week, which we were excited about, and so we added them. Doing very well. We also added a high yield bond exposure in our portfolios, again, as a way to try to increase some yield without putting too much additional equity risk. And so just to kind of show you what's happened with them. So this orange line here is going to be the S&P 500 performance over the same period of time that we're looking at. This is going to be as of yesterday's market close. And so our equity positions are up here. So just under 14% is how those 5 equity positions are now performing relative to the market. And again, so this is just how relative strength works. It gives us the opportunity to find the areas that are doing well, that have positive momentum, steering us away from the areas that have negative performance or negative relative strength, that are having falling momentum, because those are going to be drags on our performance over the long run. And so this is really what allows us to be a little more cautious with entry. We don't have to have as much equity exposure at the beginning, and we can still really make up some ground and kind of pick up steam moving along. And as we get additional indicators that we can take more positions in both these positions as well as adding, we'll be looking forward to doing that, certainly. But again, you know, the theme, I guess, for this week is just proceed with caution. So, you know, we're taking small bites at the apple at a time. It's working, and, you know, we're pleased, but we still think that there's headwinds, certainly for the market in the short term. I think that we really have to be on the lookout right now that there could be a fairly significant correction to the downside in the short term, just based upon how overextended and overbought the conditions that we are in right now. So those are things that we're looking at. Won't be surprised if we see it. So those are things that we're looking at. But again, those are some of the things I want to go over quickly tonight with you. I hope you're doing well. And as always, you can email me, AshleyR@victoryfiduciary.com, if you have questions or comments. Otherwise, we will look forward to meeting with you next week, hopefully with a negative COVID test. Take care.